What is up, world? It's your boy Ton, and you are listening to the Wonton Wealth Podcast. Here, I'm going to unravel anything and everything commercial real estate related. And more importantly, we're going to add abundant value. So if you're ready, buckle up your eardrums. All right, welcome back, people, to another episode of Wonton Wealth. Today, I have Michael Uadiale, who is a CPA, specifically a real estate CPA. I know taxes can get boring sometimes. I don't understand a lot of taxes, so I'm going to hope to bring as much value and entertainment from the tax perspective with Michael today as much as possible. Michael, if you could, give us a brief background on who you are, what you're doing now, and how that relates to real estate.
Oh, thank you, Dan. It's a pleasure to be on your show today. I'm first of all a husband, a dad, an entrepreneur, and a CPA last. And that order is more important than anything else. I am a CPA who is first of all an entrepreneur, meaning I do a lot of the things that most people are doing out there to try to make money and become financially free. So I'm a very passionate person about becoming free financially. I don't know if that tells you much, but it drives my passion on what I do.
Love that.
Thank you.
So you have spent, if I remember correctly, over 20 years, maybe 25 years in tax, and you've built I think it was a seven-figure CPA firm.
That's correct.
What first drew you into the world of real estate taxation, and why do you think CRE investors specifically need a tax CPA versus just your regular CPA?
Thank you for that question. So the tax code is, I live and breathe the tax code. Okay, so let's start from there. And really, the more you dig into our tax code, the more you find that the tax code is written for entrepreneurs. Okay, it's not. I'm sorry. I know some listeners may not fall in here, but the reality is the tax code work for those folks who are business owners. Now, among that wide expanse of business owners, the tax code is especially very favorable to people in the real estate industry. I happen to be somebody that is vast and have certifications from many countries. But I'll tell you one thing. The United States government have been very successful in using the tax code as a means to not put the burden of providing housing to its citizens using the tax code. And that happens because the tax code has lots of tax savings, lots of tax benefits for people who are in the real estate space. And anywhere you have savings, capital will move in that direction. Nothing explains that better than the most recent tax law change that happened July 4th last year, which is called the OBBBA, right? What the government did with this recent tax law change was to even turbocharge what they did in 2017. And what you're going to see happen from that is you're going to see more money moving in direction of real estate because the tax code is an incentive that the government puts in place to cause business owners to behave that the government wants them to behave. I don't know if that tells you. I'll stop there. I could go on forever.
No, that's phenomenal, right? But so the second part of my question was, why do you think people need a specific real estate CPA versus just a regular CPA?
Excellent question. It's the same reason why if you have to do a brain surgery or you have to do a heart surgery or you have to do some highly specialized medical procedure, it is not your general practitioner that you go into. Your general practitioner may diagnose to you that you have a problem with your brain, but he or she is not going to be the one that's going to be doing a surgery if such a procedure is needed. He or she is going to be looking for a specialist in that part of your body. It's no different. The tax code is thousands of pages, and we have CPAs, we have to be honest to our clients that we cannot claim to know everything on the tax code. Okay? AI or no AI. They are just people who have affinity for some lines of the tax code different from others. So the reason to have a CPA that has a deeper knowledge and specialization on real estate is because such a person is going to be able to find the nuggets for a real estate professional over and above what a general CPA will be able to provide to you.
Fair enough. Fair enough. I love that analogy. Could you walk us through a an example or one commercial real estate client story where you help them strategically plan and produce some type of game-changing result?
There is not just one, there are lots of it. Okay, so I'll just give you one most recent. I have a client who is a physician, he is a medical doctor, he's a kidney specialist. All right. But this gentleman, at the same time as he is practicing medicine, he has become a big real estate investor. In fact, he's developing some significant amount of real estate work out in Arizona, and he's based out of South California. When he came to me, all the CPAs or whoever he has met with before made him to understand that there were some benefits which he could not take because looking at him on paper, he does not qualify to be called a real estate professional. And just for the benefit of your audience, a real estate professional for the purposes of taxes is not the guy who is helping you to buy or sell real estate. A real estate professional is a specialized part of the tax code that allows you to take all the losses you may make on real estate and you can apply those losses to other income that you have from other things. So in this particular medical physician's case, he's making all this money from his practice of medicine. Now, he's building all this real estate portfolio. Okay. Now, if he was able to qualify as a real estate professional, those real estate portfolio is going to help him generate significant amount of losses, such that when he matches those losses against his medical practice income, his taxes will become zero. But all this while, when he was working with whoever he was working with, they kept telling him he could not qualify. But when he came to us, we kind of dug deeper into his situation and we coached him through how to qualify legally, ethically, and morally as a real estate professional while still making the money he's making on the medical practice side of things. And that changed his tax result magically. In fact, I wish I could show you his tax return because the refund he got from the tax return is so big, he felt something was wrong. Okay? Nothing was wrong. I mean, literally, this is a guy who is making over $1 million from his medical practice, but he's getting over $253,000 of that money back on his refund because on the real estate side, he is able to qualify genuinely. Again, anything you want to do in taxes, you don't want to play games because you don't want your clients audited and then they don't pass the audit. These are things that if he gets audited, not anybody in our practice or himself will be losing sleep.
Love it. That's an incredible story. But let's pull on that thread a little bit on the REP or the real estate professional status. Who can actually qualify and what are the stipulations in order to become a real estate professional?
It's easy but complex. Seriously, it's easy but complex. It's easy from the perspective of what does the law say? The law says for you to qualify as a real estate professional, you got to meet these two tests. The first test is you have to spend no less than 750 hours, okay, every year on real estate trade or business. That's the first test. And that's why I said there are two tests. You must meet both. No less than 50% of that person's work time gets to be spent, all right, on participating materially in the activities of their real estate. So at a 50,000 feet level, that's the two things that you need to meet, okay, to qualify to be called a real estate professional. Now, what is the complex part? The complex part of it is pretty much saying, look, for you to meet this requirement, there's what we call material participation. That's where it gets tricky because one, the IRS has what we call 7 tests of materiality. So I could be a real estate investor and I'm putting in 1,000 hours and 20 hours into real estate activities. If you dive into it and the material participation hours inside of that 1,020 does not meet any one of the 7 tests of materiality, you just got lost in the sense that you could make a whole lot of losses. Your losses then become what is called passive losses. In the case of this kidney specialist that I just gave you his story, if he does not qualify as a real estate professional, he's not completely losing those losses. He just gets to continue to carry those losses from year over year. Okay? He cannot match those losses against his medical practice income. As a business owner, time is money. If I have $253,000 today coming to me by way of a tax refund, I can go buy another property that is about 1.2 million today with that refund, compared to I keep carrying that loss year over year for the next 5, 10 years. So it's simple, but it's complex just because of the way the code is written.
Sorry. So, in your prior example with your previous client, in this story that you shared, he is a medical practitioner earning a very high income earner. So, it sounds like that, his medical practice or he might have a W-2. That is his primary work related, income. So the
That's
real
correct.
estate side is the investment side. So my question here is, how does he qualify as an REP when he is full time in a job here? He also has to meet the 750-hour requirement for the real estate.
Excellent. See, great question. Really great question. I'm going to give you the answers. You want us to pull this, and I'm going to unpack it for your listeners. Now, this is where instead of CPAs just looking at people and saying, oh, no, you don't qualify, you need to learn to go deeper. Okay? In this guy's case, he works both in Kaiser and he also owns a clinic with 2 other practitioners. All right. Now, when we began to look at his time, the first thing I made him to do is I'm like, I need you to track your time for the first 1 month for me. I need you to track all your time of what you do and all of that. And after he finished tracking the time and we met, I'm like, okay, let's go into this. When we began to look at his time in medical practice, the first thing I asked him is, I see you have a physician assistant. Tell me about that. What does your physician assistant do, right? Many people may not know this. A lot of doctors have PAs, they have physician assistants. These are not medical doctors, but they are almost like lawyers have paralegals. Okay. He began to talk to me. He was just talking conversationally like you and I chatting. And it's like, you know what? I spend a lot of my time doing round wards, meaning he goes round the clinic, checking on the patients, right? After their dialysis and whatever. And he said, but I don't really need to be doing that. My PA can do that. Okay. And he said, give me one day. Let me check with my 2 partners if they are okay with that. Say, because there's not much to that. But that was taking a lot of his time. All right. So his 2 partners said they fine with his PA being the one doing the rounds in the clinic. What did that do? That helped to significantly, in his case, reduce his time in medical practice without necessarily reducing the quality of medical delivery. All right. So instead of medical practice taking up 55% of his time and real estate work that he was doing in Arizona taking, let's say, 45, he had lots of hours go off on the medical side. So the real estate professional side of this business shoot up to over about 58%. So he met because already he was burning a lot of hours, more than 750 hours on the Arizona project because he was building some apartment buildings. He has other ones there. He has like 4 other properties in LA area. So making the hours on the real estate side wasn't really the problem. The problem was trying to be able to keep medical practice going and bring medical practice down to less than 50%.
Got it. Got it. Now, in that particular example too, could he not, if his spouse was not working, could she not become, or this is a male, I'm assuming, so his spouse, wouldn't they be able to be qualified as an REP?
I think you already stealing my thunder. Many times yeah, so yeah. So many times clients come to us and I'm asking these questions very conversationally, but I'm looking for my out. The answer is yes. Many times you find you have um I was working on a case before this call today, and the client is an owner of an IDD business agency, meaning he deals with disability clients. And he said, my wife keeps a job, but she's been thinking about whether she should stop working or not and all that kind of stuff. And I'm like, from what I see, you guys are losing more money as a family because of this W-2 job that she's keeping, because she's only making like 58 or 56,000 from a W-2 job. All right. But I was able to show to him, I said, look, if your wife stops working, you guys already have about 5 properties. We can reposition your wife to become the real estate professional in the family while you continue to make all the money that you're making, because he's running an agency that is making over 5 million gross. Okay. So these are the things that people don't look at very well. Why keep a job of 56,000 net after taxes? You're getting about 38 when you could be saving over 80 something thousand dollars in taxes, and that person not having to get on the commute to go to work every day.
Very fair. Very fair. So, what for normal real estate, commercial real estate investors, what have you seen has been the single biggest tax mistake when, in their first couple of deals or even down the road, what have you seen?
I think the biggest mistake I have seen with many of my clients is when they go into syndication. Okay. And I'm talking and I'm answering the question from a tax angle. The biggest mistake I see is they don't take the pains to talk with an attorney and a CPA that knows real estate so as to be able to read through the operating agreements of the syndication that they are becoming part of. And the reason why I say it's the biggest single mistake is if you don't know and you go into a syndication, for example, where one, you are a limited partner, but the syndication is written or the operating agreement is written in a way that it's the operating general partner that has all of the flexibility to take all of the bonus depreciation to themselves or when they take it. That's a big mistake, right? So people go into a deal and they think, oh, I'm going to get tax benefit out of it. But when I call for the operating agreement and I'm like, yeah, you're a limited partner here, but this thing is saying that, for example, the general partner is not going to do a cost segregation on the building. And I'm going to be like, why are you going into this? So that's the biggest mistake, not reading or getting somebody to read that operating agreement and help you understand whether the terms of this operating agreement is consistent with what your goals are as an investor.
And you mentioned bonus depreciation, which has been a pretty hot topic recently. Where does bonus depreciation stand today? And actually, let us explain to us what bonus depreciation is, and then let us know where it stands today and how investors should be thinking about cost seg studies or cost segregation studies in the current environment.
I'll put it this way for you. Bonus depreciation is magic. Yeah, I mean, it's magic. Really, it's magic that to the untrained mind, it almost seems illegal. Okay? But check this out. That's what the government has done. What bonus depreciation says is you taking it. So for the average mind, for the person on the street, for them to be able to deduct anything, all right, on their tax return, they must have spent money paying for that thing, right? If I'm going to deduct this phone, somehow I have incurred a cost on that phone. Bonus depreciation is kind of wacko, is different in the sense that the government has allowed me to put maybe only a down payment of 25% into a property. So let's throw out numbers here. An investor buys a property of $1 million. He or she puts 25% down, 250,000. Bonus depreciation says, okay, that building that costs $1 million, what percentage of it is the building? Just to make numbers easy, let's just say the building itself, because you cannot depreciate land. Let's say the building is 700,000. Bonus depreciation allows you, if you do cost segregation, those two things go hand in hand. I mean, I'm ashamed to say this, but I can say honestly, there are like anywhere from 50 to 60% of CPAs who are not recommending cost segregation to their clients up to today. It's insane. Bonus depreciation lets you say, look, hey, this building that is $700,000, the law allows you to break this building into 4 different parts. And when you do that cost segregation, right? Anything that is going to last less than 20 years in that building, you are allowed to write off that cost as depreciation in the first year. Okay? It's a game changer. It's huge. It's a game changer because if you look for the right deals, and what I mean by the right deals, don't go buy properties in places where the land value is 60% and the building is 40%. You want to buy properties in places where your cash flow numbers work, but your land value may be anywhere from 20% or less. What bonus depreciation lets you do, it puts you in a position where literally the money that you have put into your down payment, you can get it back by way of tax savings. So I tell my clients what bonus depreciation is doing is the government is doing your down payment for you. So
It's
that's why I call
essentially
it
a write-off.
It is. That's why I call it magic, but it's legal magic.
Love it. I love bonus appreciation, and I loved it even more when 100% came back.
Yeah. So talking about that, this is the first time in the history of this country that we've come to a situation where bonus depreciation is now 100% permanently. Remember, when it was first reintroduced in 2017, it was on a declining scale. None of us in the profession thought they were going to bring it back and make it permanent. So, well, permanent until some other government changes the tax law. So I keep saying to my clients, if real estate is your asset class of getting to financial freedom, you want to put your feet on the gas pedal now and go for it.
Of course, right? So along those same lines of bonus depreciation, you have the flip side of it, which is the recapture. Could you
Mhm.
talk to us a little bit about the bonus recapture?
Yeah. So seriously, recapture is overrated. What I mean by it's overrated, every time I hear my colleagues say, oh, but there's going to be recapture, I'm like, so what? You play with the time value of money. Okay? $1 today is worth a whole lot more than $1 5 or 10 years from now. Okay? If you are an entrepreneur that knows what you're doing and you are disciplined with your money, I'd rather have my money today than wait 10 years from now. Okay? Recapture is pretty much saying, hey, okay, yeah, you took this depreciation. Yes, I did. But it allowed me to acquire more properties. Okay? Taking that bonus depreciation, doing that cost seg, put me in a position where I ended up paying zero tax year over year, year over year. But check this out. In that year where I'm going to be selling one property, I should be thinking of buying another property such that whatever recapture I will be getting from the property I'm selling, I can nullify or neutralize that by the bonus depreciation I'm getting for the new property. So this is why you should be talking to good CPAs who are experts in the field, not talking to everybody.
Love that. Yeah, I 100% agree with you. And that's a wrap. If you've made it this far, that means you've listened to the entire episode, so thank you. I hope you enjoyed it, and if you did, please leave a review on Spotify, Apple Podcasts, or wherever you're listening from. And if you've learned something or found it useful, share it with one of your homies. And if you want to get in touch with me, I'm pretty active on IG. My handle is pro _TANH. Reach out, let me know what you liked, what you didn't like, or what you want to hear about in the future. I'm here to tailor this to you. Until next time.